I'm going to address why does a max-funded IUL pass the safety test for money better than banks and credit unions. Get ready, by the end of this episode, you will understand why legal reserve insurance companies are the backbone of America. So I'm Doug Andrew. I've been a financial strategist for north of 48 years, helping people optimize their financial assets and also other assets on the family balance sheet. We talk about those on this channel. These are the intellectual and foundational assets that all of us possess. But this episode is talking about money. And so when people have come to me for nearly 5 decades, they want to be able to set aside their money in a safe environment where hopefully they will not lose principal, and they want it in safe institutions. When we talk about safety, there's actually 2 different definitions. One is the safety of the institution. A lot of people think that money in a bank or a credit union is one of the safest places to deposit money. Why? Because it has that FDIC insurance on it. Did you notice? It's insurance that makes it safe. But who's the insurance company operated by at a bank? Federal Deposit Insurance. The government. People sort of go, well, the government, they can always sort of print more money or taxes. Yep. And so people get sort of lured into a sense of, I think, false security, thinking, the government is protecting this, so the safest place is to have my money in a bank. Well, let's talk about the second definition of safety, and that means safety of principal, or safety of keeping up with the purchasing power of the dollar because of inflation. Because when the government prints more money, that causes inflation, and you didn't really have safety of your principal. Or if your money is invested in the market and the market goes through its gyrations, you can lose your principal. A lot of people don't think about this. So I like to use both definitions. I want the safety of the institution. I want to put my money where the banks put their money for liquidity and safety. But I also want to have safety of principal, which means I don't want to lose money that I invest into the investment or the instrument financially. I want to protect my principal, but any year that I make money, I want that money, that profit, to become newly protected principal, meaning I don't want to ever lose in future years money I've made in previous years. Most financial advisors don't know how to do that. They just say, just hang on. When it goes down, it'll come back up again. Hang on, the market always comes back. And so what happened in 2001, 2002, 2003, many Americans lost 40% on their retirement nest eggs. They maybe had $1 million in the year 2000. It was only worth $600,000 by the end of 2003. It took 4 years to make back what they lost. They were just back to break even again. Now, people using my favorite vehicle, they had safety of principal. It's what I call a laser fund, liquid asset safely earning return, spells an acronym LASER. And so they did not lose their $1 million. They may not have made very much in 2001 to 2003, but they didn't lose. They were protected from loss. And then in 2004, 5, 6, 7, they were able to make money. At the end of 2007, their $1 million was worth as much as $2 million, when most people were barely back to break even, because they did not lose when the market went down. They had safety of principal. And then they made money, and so they had $2 million. Then what happened in 2008? The market dropped 40% again. People's $1 million nest egg that they finally got back to break even went down to $600,000 again for the second time in a decade. The people using my favorite vehicle, the laser fund, their $2 million just stayed there at $2 million in 2008. They didn't lose what they had made the previous 4 years. And in 2009, they started making money again. And instead of waiting 4 years to get back to break even, which most Americans, it took till 2012 for their $600,000 to come back to $1 million again, to break even. That's why we call it the Great Recession or the lost decade. It was actually 12 years. Many people ended up with tripling their money in that time period because they did not lose when the market went down. They may not have made very much, but they didn't lose. And they started making money again. This is called indexing. This is how you have safety of principal. So let's talk about what this means historically. But before I go there, if this is intriguing you, post a comment, click like, share it with somebody who you think would benefit from this video. But I would love for you to subscribe. It's easy. Click on subscribe. It's free. And click the little bell when you do so you'll be notified every time I post a new episode, which I do almost on a daily basis. But stay with me to the end. I want to gift you a copy of my 300-page book, The Laser Fund. Absolutely free. I'll pay for the book. So folks, during the Great Depression, we had banks close. Real estate dropped 80%, and there were 40% of banks that never reopened again. There was not one single legal reserve insurance company that went under in the Great Depression. Money was safe in those. Maybe you only earned 2.5% or 3%, but when things go really bad, people get more concerned about the return of their money instead of the return on their money. In 2008, we had 400 banks go under in that mortgage meltdown. 900 more were on the brink of going under. It was called the watch list. And how many legal reserve insurance companies went under in 2008? 0. In fact, the federal government asked the 5 major banks to disclose where they had their Tier 1 assets for liquidity and safety. And the bank said, well, in insurance companies, because insurance companies are usually rated 6 notches higher in safety than most banks are rated. A lot of banks are only rated maybe triple B by Standard & Poor's. A lot of these insurance companies are rated AA or AAA. You may not know, but that's like 6 notches higher in safety. You know what the banks are doing? In 2008, they were going, well, yeah, we are taking the public's money, and people deposit money in a bank, and the banks were paying 1%, let's say, not even that high. And they're turning around and increasing the safety by about 5 or 6 notches higher in safety by putting some of your money into insurance companies. And they are increasing the rate of return because they're earning more like 5%. 5% is how much more than 1%? Don't say 4. They're paying you $10,000 of interest on $1 million in their bank, and they're turning around and making $50,000. $50,000 is 500% or 5 times $10,000. This is how money works. But they're increasing the safety. You can bypass the middleman and put your money straight into the insurance company and use what banks do. They have bank-owned life insurance. That's called BOLI. Bank-owned life insurance, that's an acronym. Who do they own it on? It doesn't matter, stockholders, a board of director members, or whatever. It's the owner of the insurance policy that gets all the tax-free accumulation and so forth. Remember that. There's other episodes on this channel that'll help you understand this concept. The point is this: legal reserve insurance companies are the backbone of America and the backbone of the world. And that's where many of these other financial institutions put their money. That's where many governments go to for help when they get into trouble. When banks and credit unions put 30 to 40% of their Tier 1 assets into insurance companies for liquidity and to increase the safety, we ought to be thinking, why don't I take advantage of that? Why don't I bypass the middleman? Well, you can. And so the point is, most insurance companies are rated 5, 6 notches higher in safety than most banks. So why would you feel better about having your money in a bank down the street because it has a drive-up window and you think that's liquidity, when really that's just convenience? Why would you have your money in a bank or credit union thinking that's the safest way because of FDIC? What does FDIC mean? Federal Deposit Insurance. Why rely on the government's insurance company that sometimes has almost been on the brink of going broke when they bailed out, the savings and loans industry, or in 2008, because you want to go straight to where they put their money. And so that's what I'm talking about. Serious cash, whether it's emergency funds, retirement planning, working capital for business. I put all of that into IUL, Indexed Universal Life. I maximum fund it. I'm earning great rates of return, netting me 8, 9, 10% tax-free, but it's liquid and it's safe. As far as I'm concerned, it's the last domino that would fall if we had a total financial collapse in America. And you would have so much warning from all of these other institutions going under that you could grab your money, but let me ask you something. Where would you put it? If it's that bad, the American dollar would be worthless. You better be able to grow carrots in your backyard. Even owning gold and silver won't help you in that situation because you can't eat the gold and silver. If this is making sense, I want you to learn and read why I feel like the laser fund is the best place to put money. Serious cash for liquidity safety, predictable rates of return, tax-free, and it would be the last domino to fall if we had a total collapse of all the financial institutions in America. Does that make sense? If you want to learn more, I would recommend you read this book. It's been flying off of our warehouse shelves. It's called The Laser Fund. And this will teach you how to diversify and create the foundation for a tax-free retirement, but how to pass the liquidity, safety, rate of return test with flying colors and have it be tax-free to boot. That's what these 4 pillars are. These are the key elements of a prudent investment. As far as I'm concerned, being a financial strategist, nothing comes close to passing the safety test better than a max-funded indexed insurance contract where you're safe from market loss. You take advantage when the market goes up. You don't lose when the market goes down because your money is not at risk in the market. You have safety of the institution. You have safety of your principal. This is crucial for you so that you will not outlive your money. So go to laserfund.com, click on the link below. You contribute a nominal amount toward the shipping and handling, have some skin in the game, and I'll cover the rest of that, and I'll pay for the book. I'll fire out a copy to you. This is 300 pages. It's actually divided up into 2 books. This one is for the left brain learner, all the charts and graphs and explanations. If you learn more by stories, you flip it over and read this one. And this has 12 chapters with all kinds of stories and examples of how savvy people use the laser fund for all kinds of financial goals. It's the dream solution for an emergency fund, retirement planning, working capital for your business, real estate management, on and on and on. So claim your free copy now. This is the beginning of your better, safer future.